Hello, and welcome to today's seminar, How to Finance E-Commerce Inventory. Obtaining adequate inventory can be a challenge for small and mid-sized e-commerce merchants. Inventory financing can solve that problem. Today, we will look at the various mechanisms available to e-commerce merchants to fund the purchase of inventory. I'm Marcia Kaplan, a consultant and contributor to Practical E-Commerce, and I will explain the advantages and disadvantages of each funding resource so you can decide which is best for you. The 5 key points we will cover today include first, a definition of inventory financing, and second, why small e-commerce merchants should consider financing inventory. Third, I'll talk about the benefits and disadvantages of inventory financing. Next, I'll describe the many ways to fund inventory purchases, along with the relative pros and cons of each. Lastly, I will present a few common mistakes that e-commerce merchants make that could prevent them from getting financing. So let's begin. What exactly is inventory financing? It's an asset-based short-term loan or line of credit that is extended to small business owners specifically to buy inventory. The inventory is the collateral for the loan. Why would you want to finance your inventory? Most small businesses have competing needs for a limited amount of cash. By financing inventory, merchants can be assured they have an adequate amount of stock to meet customer demand. If you know that you could sell more goods if you had the inventory but don't have the cash to buy it, inventory financing is a good option for you. If you have a seasonal business and need to purchase extra inventory during peak sales seasons but don't have adequate cash on hand, inventory financing can solve your dilemma. You can lose holiday sales if you don't have enough inventory, and holiday sales often make up a high percentage of annual revenues. Also, your competitors are likely financing their inventory. In a 2016 survey of small businesses by research firm Edelman Intelligence, 51% of the businesses asked said the most common reason for seeking a loan was for inventory purchases. So what are the benefits of inventory financing? By financing your inventory, you can put your cash to other use for marketing, advertising, or hiring seasonal employees. Having more inventory on hand can boost your sales and help your business grow. It also allows businesses to buy in bulk. Manufacturers and wholesalers often offer discounts on bulk purchases, and shipping costs may be cheaper as well. Inventory financing also helps you avoid out-of-stock situations. This is especially important for e-commerce merchants. A potential customer does not want to spend time on your site researching products only to find out you are out of stock. That person will likely not come back. If you sell on a marketplace, it's likely that another seller has the item that you are out of. So you will lose that sale and perhaps jeopardize your standing in the marketplace. If you are an Amazon marketplace, either FBA or FBM seller, and you run out of inventory, your seller performance rank will drop fast because your competitors are getting the sales. What are some of the disadvantages of inventory financing? Loans or lines of credit can be used only for inventory, not other working capital needs. Inventory loans are risky. Sales can decline, inventory can lose value, goods can be lost, stolen, or damaged. Also, you have to pay the loan back fairly quickly, and if you didn't calculate your inventory needs correctly, your sales may not cover the amount you need to repay. You may be paying higher interest rates as well. Inventory financing is typically considered less secure than a traditional loan, so lenders charge a higher interest rate. What are some common qualifiers for obtaining financing? Credit scores are one. There's a minimum of 640 for a traditional bank, 620 for an SBA loan, and $550 for an online lender. This is your personal credit score. If your score is at 550, you'll probably be charged a higher interest rate. Potential lenders will also look at how long a company has been in business. Usually, lenders want at least a year, although some may consider 6 months. Lenders also want a stable cash flow. Lenders will look carefully at the amount of annual revenue. For a traditional lender, you should have over $100,000. For an online lender, usually $100,000 is fine, and a few require only $50,000. What will lenders ask you to provide when you ask for a loan? They'll want to see profit and loss statements, all of your balance sheets, and your business tax returns for 1 to 2 years. Sometimes they'll also ask for a personal tax return. They'll want to look at your sales forecasts, your business bank statements, and your inventory records. There are many types of inventory financing, but you may qualify for only a few. First, we'll discuss traditional bank loans. Over the past 10 years, it has become much more difficult for a small business to get a loan from a traditional bank. They prefer large businesses who take out large loans. Traditional commercial banks make more money on larger loans and have strict criteria that few small businesses can meet. Rejection rates range from 50% to 89% for small businesses. Advantages of traditional loans are predictable monthly payments and lower interest rates than alternative loans. They also have longer payoff times. Disadvantages are extensive paperwork, longer time for loan approval, and high credit standards, plus the need for an established business history. Traditional lenders may also require a field audit of your inventory. Next, we'll look at a business line of credit. So another way many business owners finance inventory purchases is with a business line of credit. Unlike a term loan, a line of credit allows the business owner to access part or all of the credit line, repay it, and access it again as needed. Interest is only charged on the amount the business owner uses. So the flexibility of a line of credit allows the business to access funds when needed without going through additional credit approvals during the term of the credit line. When you open a line of credit, you'll receive access to a stated amount of funds to use as needed. So this is a very flexible alternative. An unsecured line of credit generally has a higher interest rate. The annual percentage rate can range from 13.99% to 55%. However, remember you only pay interest on the portion of the credit line you use. With a line of credit, you can get funding up to $250,000, and repayment terms will generally be 6 to 12 months. Next, we'll discuss asset-based loans. Asset-based lenders look at two sets of assets, accounts receivable and inventory, in deciding whether or not to approve a loan. They usually serve businesses that have low credit scores and low profits. Inventory is the collateral, and asset-based lenders will do an on-site appraisal of your inventory prior to you getting approved. Asset-based loans have interest rates of approximately 10% to 18%. Businesses that need a larger funding amount, $500,000 for example, may wish to look at asset-based lenders because they do have higher loan limits. Let's look at vendor financing. When seeking inventory financing, you can ask your vendors if they will allow you to pay on credit. They will review your purchase and payment history as well as your credit score. They may collect a percentage of payment up front and defer the rest to an agreed-upon date. If you have a good relationship, you should be able to negotiate payment in full after 30 to 90 days. Some vendors will do this interest-free, while others charge monthly interest. Some suppliers offer this as a formal program, while others may extend terms if you ask and have been a steady and good customer. The next option is a merchant cash advance. This is a purchase of your future revenue at a discount. It's not a loan. Similar to accounts receivable factoring, the funder will buy a portion of your future revenue. The pros are that a merchant cash advance is very fast, often within 48 hours. It is based on your revenue track record and includes little in the way of other qualifications, such as credit scores or minimum revenues. It also typically does not require a lien on your business. The disadvantages are it's very expensive. Since it is not a loan, the merchant is charged a fee or a factor rate, not an interest rate. The fee can be 1% to 2% per week, and you may be required to sign a personal guarantee, which means if you don't pay your loan back with your business revenue, they can go after your personal assets. The term in which the money is paid back varies, but typically it ranges anywhere from 3 to 18 months, with most advances falling in the 6 to 12-month range. So a high percentage of future revenue will be devoted to paying back the advance. Another option is equity finance. So rather than getting a loan, with equity finance, you sell a portion of your business in exchange for an investment, and that money can be used to fund your inventory. The advantages are that investors are often experts who can provide advice and add value to your e-commerce business. They have a stake in your doing well because if you fail, they fail. The disadvantages is that, one, it's a one-time financing, not a continuous infusion of cash, and you may have to give up a significant portion of your business to secure the funds you need. A relatively new alternative funding mechanism is crowdfunding your inventory. Inventory crowdfunding lets anyone pay for and sell your inventory via a consignment agreement. Every buyer gets a store on the crowdfunding site, and they can use that to market and sell your products. The buyers own the products, and they help fund and take on the risk, as they must sell the product to get revenue. You can also sell your product in your own store on the same crowdfunding site. This option is reputation-based, and you benefit from building a relationship with the crowdfunding community. Since other people sell your products, these consignments don't require the amount of marketing other crowdfunding methods do. The disadvantage is, depending on the business, it can require strict warrants like a personal guarantee. Next, we'll discuss online lenders. Online lenders have become a valued source of funding for e-commerce merchants and other small businesses. In contrast to traditional lenders, they offer a streamlined loan process. It may take only 15 minutes to fill out an online loan application. The lender can make a decision in 1 to 2 days, and if approved, the money is available to you in 24 hours. Most online lenders offer both regular loans and lines of credit. They will also consider businesses with less revenue and merchants with lower personal credit scores than traditional lenders, making them attractive to many online sellers. The loans are usually not secured by inventory, but rather a general lien on the assets of the business backed by a personal guarantee. Typically, online lenders will lend up to $250,000, a few up to $500,000. Minimums can be as low as $500, but most have a $5,000 minimum. Online financing lenders will charge you up to 3% of your loan for every 30 days that you are in repayment. The average annual percentage rate falls between 21% and 61%. However, merchants with healthy sales, solid financials, and excellent credit scores can sometimes get an interest rate closer to 10%. Repayment terms will typically be between 1 and 6 months. As with traditional loans, there are origination fees. Some online lenders also charge monthly fees. Repayment terms can be daily or weekly, and automatic debits from a bank account are commonly required. Next, I would like to discuss some common e-commerce merchant mistakes. Many merchants initially manage inventory from their e-commerce platform. As a business acquires more sales channels, it often needs a more robust inventory management system. Not having a good inventory management system in place will discourage asset-based lenders from making a loan. Another mistake is not calculating and planning the requirement for inventories carefully. Having too much inventory is just as damaging as having too little, and merchants may overorder during holiday seasons. That's why having a good inventory management system is crucial. Not having up-to-date financials is also a problem. Any lender would want to see the most current records. So let's summarize what we've discussed today. We've covered why e-commerce merchants may wish to consider using inventory financing, what the benefits and disadvantages are, and what options are available to small e-commerce businesses. I've reviewed the types of financing and the benefits and disadvantages of each option. We've also looked at some mistakes that e-commerce merchants should avoid. That wraps up my presentation.